When most people think of Brazil, they picture football, samba, or the Amazon rainforest. But the reality is far more complex. Brazil is the world's eighth largest economy with vast natural resources including iron ore, soybeans, deep sea oil, and green energy potential, earning it the nickname Res, our monster. On paper, these resources should give Brazil a major advantage in global growth. Yet for decades it has been trapped in the middle links. One trap, with uneven productivity growth, lagging infrastructure, and high business costs known locally as the Brazil cost. These structural constraints have limited its transition to a high-income nation. Looking at Brazil's strengths and weaknesses and national conditions, it becomes clear that the country has unique advantages. Strengths include a large domestic market, with over 200 million people and a high proportion of young population, providing substantial consumption potential, abundant natural resources including iron ore, soybeans, oil, and renewable energy sources such as hydro, wind and solar, advanced agricultural technology led by Embrapa, and a world-class aerospace industry, with Embraer holding a strong position in the regional aviation market. At the same time, weaknesses are significant. Outdated infrastructure with bottlenecks in ports, railways, and energy networks. Raising logistics costs, complex political and tax environment increasing, business difficulty, institutional inefficiency and corruption, and social inequality with a large urban-rural and wealth gap. These advantages and disadvantages shape Brazil's development trajectory. The economy maintains medium to high growth, but structural reforms are slow. Industrialization and high-tech development are constrained, while services and digital economy become new growth drivers. Brazil's emerging industries such as renewable energy, digital finance, and electric vehicles are growing rapidly. By contrast, China has more complete infrastructure, a highly industrialized manufacturing system, a large population with higher education levels, stronger institutional execution, and more robust technological innovation. Opacity. China's imports of iron ore primarily come from Brazil and Australia, around 1 billion tons annually, and soybean imports are about 100 million tons, showing high complementarity in resources and trade between the two countries. In terms of employment and business, Brazil offers technical positions in high-end manufacturing and renewable energy, while China's industries are larger with stronger R&D and export capabilities. In recent years, Chinese enterprises in Brazil have shifted from resource extraction to manufacturing, services, and renewable energy sectors. It produces electric vehicles locally to meet domestic demand and export to neighboring markets. Huawei participates in digital infrastructure and 5G networks. Didi and other tech firms enter ride-sharing and local services. Brazil's annual export volume includes about 400 million tons of iron ore, 130 million tons of soybeans, over 2 million barrels per day of oil, and renewable energy capacity, growing 15 to 18% annually, supporting green energy development. And then, uh, I, okay. By comparison, China's imports of iron ore are around 1 billion tons, soy beans about 100 million tons, and renewable energy equipment exports grow. They're 20%, showing China's larger scale and industrial integration capability. And overall, Brazil has abundant resources and market potential, but structure, our bottlenecks limit long-term development. China has strong infrastructure, complete industrial systems, and robust innovation capacity. Chinese investment in Brazil can secure resources and build long-term returns through renewable energy manufacturing and services. For investors and entrepreneurs, the key is identifying high-value sectors, leveraging policy and market trends, combining Brazil-China complementary advantages, seizing opportunity, ties in renewable energy, digital finance, and industrial upgrading, while managing local risk. Brazil is both a resource monster and a middle income. Sharp example, understanding its national conditions, strengths, and weaknesses. Yes, and comparison with China is crucial for successful investment and in this strategy in Brazil.